we've still got our problem. Remember, we've got to say, how do we get mortgages to these two Herberts? Because there aren't enough of them. Nice gentleman over there. So what they said is, all right, why don't we insure this? All right? We will start to put into our pot of mortgages a few really good mortgages for people who are definitely going to pay, and we'll sort in a few of these dodgy-looking characters because there's lots of them. Right? But then if anyone questions whether it's worth what it's worth, we'll go to a company which will insure it. AIG was one, right? And it became quite lucrative because what you did is you said they would say to the banks who were selling these securities, we'll insure that. What they meant is, if this security made up of these mortgages didn't pay out what it was supposed to, let's say instead of just 3 of them, the mortgages in there defaulting, 20 of them did. So this bit of paper was just not paying out what I said it would when I sold it. The insurer will say, we'll pay up to the full price. And in return, like any insurance company, you, the bank, just pay us an annuity. That's fine. Once they'd done that, you could take a security which was made up of a few good mortgages, lots of rubbish ones, and just wrap it in some insurance, which is essentially the same as what every tin pot idiot through history has done. They start out minting solid silver coins with the emperor's head on it, and after a while they think there's not enough of these damn things, so someone digs up some tin, they hammer them into the same shape, and they can paint a bit of gold or silver on the outside. That's what happened in the 90s particularly. The insurance, which you might have heard of, they called CDSs. Okay. It doesn't matter. They dressed it up. It's like Catholic liturgy. They dressed it up with lots of terminology, which is merely designed to make you go, I have no idea what you're on about. Credit default swaps. It's insurance. But there's a clever thing about this insurance. The kind of insurance we're used to is friendly insurance. Right? I insure my house against it burning down. Sensible thing to do. But imagine if one day, in passing, my insurance agent said, do you know he's insured your house as well? I think, that's very friendly of him. But then, and I might be a bit confused, but I think that's a friendly young chap. I've met him for drinks. Very nice, thank you. And then I find out that everybody in the room has insured my house against burning down. And then I think, hang on, why would they do that? And then the penny drops. If my house burns down, they're all going to be paid a fortune. Okay, now how safe do I feel? That's what has happened. That's why you hear on the news about how the derivatives market or the insurance market of the CDS is so huge. They talk about trillions and trillions. You think, how can there be that money? There isn't enough money. But everyone is betting against things. And what happened, as we went into the noughties, well named, the banks had sold mortgages to all the upstanding gentlemen. They'd sold mortgages to lots of fairly dodgy characters, but still had nice shirts, and wrapped them in some insurance. And the insurance people were happy about that because they were getting paid. And because it was wrapped in insurance, like a fake coin wrapped in gold, it looked really shiny. So it was all AAA rated. It was rubbish inside. It was rubbish. People like him. But it was wrapped in insurance, which said, even no matter what kind of dodgy bloke he is, if it goes wrong, we're going to pay you. So it's AAA rated. Everyone rated it AAA. And then it got worse, because everyone's bonuses and everyone's Porsches and everyone's houses in the country depended on making more and more of these. You were just rolling in a lap of luxury. You had baths in Bollinger, never mind drinking it, and you wanted more. So, and this is true, they started creating offshore companies, which are here referred to as SIVs, Special Investment Vehicles. It's just an offshore company, and its job was to buy securities, which by this time they'd called CDOs, collateralized debt obligations. Same thing, new term. And it was because, as we went into 2004, 2005, the amount of stuff being sold had just exploded. But some people knew, some people had met him, and were thinking, he really isn't going to pay, is he? And so they didn't want to buy some of this stuff. But if the word got out that people were no longer buying the slightly dodgy securities, the world would fall in. It needed to sell them. So they actually set up companies. Merrill Lynch set up companies, RBS set up companies, offshore companies which they gave the money to, and their job was to buy the securities which those banks had made but couldn't sell. And you think, well, that's just robbing Peter to rob Paul. No one's even getting paid here. But it meant that every month they could say the sales of securities are just going up and up and up. And for a while it worked. It worked. But of course you can see where this is going. It's like accelerating towards the edge of a cliff. At some point, they couldn't create enough. And there are collateralized debt obligations, those SIV vehicles, which have bought tranches of 15 or 20 other ones, which were never going to succeed. They were all rubbish. Right? Now that's bad enough. But then one other really dreadful thing had happened to the banks. They started to smoke their own dope, basically. They started to keep a lot of this dodgy paper. And this is where the real idiocy set in. Because the great thing about dodgy mortgages is that you sell them for a higher interest rate. You're an upstanding gent. I can't charge you a lot. I know you're going to repay. You know you're dodgy. So when I say it's 7%, you go, yeah, sure. Which means that bit of paper on face value is worth quite a lot. It'll give you a higher return than a sensible mortgage to a sensible person who I'm only charging 3%. The banks started keeping this stuff. It was counterfeit, but they kept it. So then when they got to the point where they couldn't set up any more SIVs to buy any more of the rubbish, they thought, the game's up, boys. And then someone else from the bank came along and said, I'm really sorry, but I bought 6 billion of that stuff. The banks were sitting on it. That's when the crisis happened. Right? So they changed the nature of banking, they changed the nature of money, they changed the nature of debt. Right? They made debt into a currency which they could buy and sell and print up, and then they adulterated it, they devalued it. Right? That is what happened. So is there a liquidity crisis? Yeah, because no one would lend, the banks wouldn't lend to each other because they knew the assets, as we've just described them, they weren't worth much. But that's the true nature of the crisis, a solvency crisis. They were sitting on billions and billions and billions of bits of paper which at face value said they were worth this, wrapped in all kinds of insurance. But the actual asset underneath, his ability to pay me back and the house that he's sitting in, just weren't worth what they said they were. And of course the insurance companies never had the amount of money to pay out on all of these at the same time. That's not the way insurance works. No insurance company has the amount of money to pay out on all of its policies at the same time. That's what insurers get paid for. They figure out what's the likelihood of having to pay out, and they say it's 3%. Right, well, we'll keep 3% of the money necessary. The rest, it goes. But they were all buying the same rubbish. So when the rubbish imploded, it imploded everywhere at the same time. So the insurers went bust. AIG was the insurer. They went under. Right? Taking with them the short-term funding for everybody else. So that is a perfectly viable view of what happened. And it cannot be solved by simply giving the banks money, because it's not a liquidity crisis. Right? So this is what made me furious. Now I want to jump ahead. And that's the sketch I want to give you. You may agree with it, disagree with it, but at least it gives you an alternative. Right? Now, that played out backwards and forwards and bailing out this and that bank collapsing and all the rest of it. Now we jump ahead to the next year. And suddenly it's no longer bank crisis, it's sovereign crisis. Right? Now it's nations. It's actually the same thing. All right? For 2 reasons. One, banks gave mortgages to subprime borrowers, people who were not that likely to be able to pay back, but there were lots of them, and so long as the bubble didn't burst, the rate of interest they were charging was quite high, therefore it made this bit of paper seemingly like a good return investment. We have subprime nations, right? Goldman Sachs could have lent to Switzerland and got, I don't know, 1.5%, but they didn't. They didn't buy Swiss debt. They bought Greek debt, and Spanish debt, and Italian debt, and they bought more of it after the crisis began than before. It accelerated. Why? For the same reason, because old Papadopoulos over here is still the same dodgy character, and therefore he's going to pay me a higher rate of interest. So we had a surge in subprime lending to nations. And it's more irritating than that, because why did the nations have to borrow so much suddenly? Well, admittedly, nations like Greece and Spain had been living beyond their means and had been borrowing and spending more than they had. Fine, I accept that, that's not a problem. Of course, it wasn't a problem for the banks in all those years this was going on, so it wasn't a crisis. The crisis came after there was a sudden massive thumping increase in the amount of money which these central banks and nations the amount of debt they'd had to take on, which was bailing out the banks. So they bail out the banks for several hundred billion, and then they didn't print that money up, because unlike the UK, they don't have the power to print up. Spain and Italy and Greece can't print their own money. They're in the euro. Now, I'm not going to get into a debate about whether the euro is good or bad, because it's a whole other debate. The fact of the matter is they couldn't just print money up. So here they are, they need money to bail out the banks who've been subprime lending foolishly. So they go and they borrow money from the banks, because the banks print up a security saying that you'll pay them back. And the nation signs on the back, the nation has now got some money, and then they give it back to the bank who gave it to them to bail them out. And you think, well, how the hell does that improve things? And the difference is the nation's signature on the back. That's the only difference. And that signature changed everything. That meant the money that the banks were owed was no longer just guaranteed by a signature from some bloke living in the sticks who said he'd pay his mortgage back. Yet that had now been replaced. Hundreds of billions of euros worth of those worthless signatures had been replaced by a signature which said, I, the taxpayer, in perpetuity, will pay you out of my future labour however much you want. That's a good guarantee. And that's what happened next. But it was still subprime. Now the obvious question to ask is, okay, why did they go and do this? I mean, looking back now, you'd say, weren't they just creating the massive problem we've got now? Well, hindsight is like that. Although I still think it's a very good question, because I think they did know, they could foresee what was going to happen. Because I could foresee, and people like me could foresee, and if I could, then they could. So why did they lend to all these subprime nations hand over fist? Why did they buy their debt? It's the same thing. And it's two terminologies for the same thing. I'm lending you money. Why did they do that? And it goes back to an old-fashioned term, usury. What a usurer does, we think of usury as just charging someone an immense amount of interest. That's a stupid usurer. That's a usurer who will not be a usurer for long, because he'll just simply ruin the people that he's after. They'll go bankrupt and he's out of business. The clever usurer does something else. He advances slightly more money to you than you can pay back, right? But says to you, if you can't pay this back now, don't worry, we'll roll it over for you. We'll extend we'll amalgamate your debt into one easy monthly package, and we'll extend the length of time and write you a new thing. That's what they did, called debt farming, or debt indenture. And you see, nations are the perfect entity to do it to. To get a person into that, you have to be quite careful. I can get you in deep debt, but not so deep that you just emigrate or declare yourself bankrupt, right? But you can still get out, that could still happen. Nations don't go bankrupt, because they will always be able to raise taxes. So if you can get a nation into that position, you needn't do anything for the rest of eternity. You just basically put a catheter into an artery of a nation, and it's, as long as their heart beats, it'll just flow out from them to you. So that's what they did. And that's fine in a kind of really unpleasant way. And it also did something else. Because when you've got that coming in, it did something else to the banks, which is they said, we're always going to be able to service this debt. There's always going to be this money coming in, right? So getting back to this idea of it being money, they made that kind of national debt into money. Instead of having an agreement with someone for 30 years on a bit of paper, which means if I didn't want this, if I didn't want to keep this in my books as a bank and I wanted to sell it to you, you'd have to be willing to buy a 30-year bond. That's a lot. So what all the banks did, all of them, and I know because I've talked to people who did it, they would swap out long-dated debt where the contract said 30 years, for shorter and shorter duration, right? So that a bank would take on that debt, but only for 6 months. So in the market, it meant that they were trading backwards and forwards as securities. When you bought part of a mortgage, you weren't buying it for 30 years, you weren't saddled, you weren't tying up your money for that length of time. You were buying shorter and shorter duration debt, which didn't seem a problem to them, because they said, well, someone will always be able to take on this debt, your debt, which is being rolled over, but we're not rolling it into a 30-year agreement, we'll roll it into just 6 months, which makes it very liquid. I can always think there's going to be someone in the market who will be willing to buy that off me, right, if I suddenly need the cash, which from their point of view sounds sensible. You're making it very sellable. But it also meant it was very unstable, because everyone's debt, all the banks are holding bits of paper which are only good for 30 days, 90 days. Which is why when the crisis happened, it happened so fast. And banks were suddenly, they were saying, we're fine, we're capitalised. And they go, oh my God, we need 20 billion. That's why the Irish bank, well, the German Irish bank debt fell over. Because it had to have a constant source of this short-term debt, and there wasn't any. So they've done subprime for ordinary people. Having run out of them and that all gone nasty, they then did subprime for whole nations. So then you think, well, is there a way out of that? Right? Because the problem is, where there was an alternative view, which I've begun to sketch out for you, and there were alternative remedies to that than the ones we pursued. But unfortunately, we've been marched backwards into actions which were designed to deal with a liquidity crisis, which it wasn't, so we took the wrong medicine. But the wrong medicine has been very expensive. So we are now a long way down a very bad road. Right? The solutions which we could have taken in 2007, 2008, we could still take now, but they'll be more painful, because on top of the debt that there was then, we've now piled several trillion more. So there's no pain-free way out, at all. And it'll be more painful now, even if we decide to do the right things, than had we decided to do them 2 years ago.